Hello, doctor. Hello, Dr. Tahri. We hope you had a good weekend. So without further ado, let's get into the financial analysis of the Intel Corporation. So in our team, we have Ayman Al-Fattali, Adnan Al-Alawi, and myself, Alauddin Tabi. For the abstract, we won't give an introduction about the Intel Corporation because not the majority, but all of us know what Intel is about. So we are going to analyze financial data using values provided by the company itself. So for the introduction, we will have the data and methodology, and in this data we have the financial data. So this is the data we used, this and in this slide we used to calculate all of the ratios and to do the horizontal, the vertical, and the trend analysis. So for the horizontal analysis, as we see on the screen, there has been a slight increase of 1% in the sales from 2019 to 2020. That increase is due to the increase of quantities of units sold and the increase of some price per unit sold by the company, in addition to the strategy followed by the company itself. Since there has been an increase in sales, we expected an increase in cost of goods sold as well. There has been a huge increase in interest expense of 29%, which means that the company increased its loan during the year 2020. There has been also an increase of 82% in cash. That is because of the investments the company made in addition to the increase of the sales volume also. The cost of goods sold increased slightly if we compare it with the increase of the assets, that was about 12%, and there has been an increase in inventory of 4%, which means that the company is storing more goods compared to a precedent year. However, there is something that is a bit surprising, which is the increase of the gross margin with 3%, even if we have an increase of 12% in the cost of goods sold, as well as a 82% increase in cash. But we shouldn't disregard the increase of the liabilities of 22%, which was stated above because the heavy loan that the company took or the heavy accounts payable. Moving forward, we have the trend analysis. So as we see on the screen and as it is stated on the screen, the sales increased and kept increasing from the year 2017 to 2020. And the cost of goods sold kept increasing except for the year 2018, in which from the financial data, it has a very heavy cost of goods sold due to the heavy increase of the sales. And lastly, the gross margin kept the same tendency as the cost of goods sold, because simply it is the same. It was the same reason for the change in cost of goods sold. So here is the graphs for the trend analysis, and without further ado, I will leave the floor to my teammate Adnan, who will present the vertical analysis.
Thank you, Alauddin. So for the vertical analysis, we can interpret it as the gross margin, operating expenses, net operating income, interest expense, the net operating income. So the net income remained a relatively equal representation with respect to sales, but for the cost of goods sold and the income tax, it changed heavily. Also, for the accounts that represented the largest portion in both 2019 and 2020 are the cost of goods sold, the gross margin, and the net income before taxes. So now, since we're done with the horizontal trend and vertical analysis, we're going to move to the liquidity ratios of Intel Corporation. So the current ratios determine the company's short-term debt-paying ability. For our company Intel, the current ratio was fantastically higher in 2020 than 2019. And this is due to the dramatic increase of current assets from roughly 31 to 43 billion, while the current liabilities were approximately the same with a slight change of $2 billion. All of that resulted obviously in the increase of the current ratio with 36%. That is so huge. However, the asset test also increased, but only with 23%, which is less than the current ratio with 13%. The thing that explains that the assets like the inventory increased heavily. Moving on to the asset management ratio for Intel Corporation for both 2019 and 2020. From the data and the results mentioned above related to the asset management ratio, we can simply notice that the inventory turnover increased with 7%, and that can be simply explained by the increase of the cost of goods sold with 15%. The thing that simply explains the decrease of the average sale period with 7%, which is about half the increase of cost of goods sold. And this change of percentage of increase and decrease returns to the change of the average inventory. Moving forward, the receivable turnover increased slightly with less than 1% because the sales on account increased with 8%. But the average account receivable increased with 9%. The thing that remained the average sale collection period about the same. Another thing is that the total asset turnover decreased with 7% for the simple reason that the sales increased with 8%, but the average total asset decreased by 50%. Now, I will leave the floor to Ayman Faddali to explain the debt ratio and the other ratios for intercompany.
Thank you, Adnan, for leaving the floor for me. So the debt ratio of intercorporation, as we can see in the table, the debt ratio of intercorporation was calculated between 2019 and 2020. We can notice that the debt to equity ratio increased by 17%, and this can be explained by the remarkable increase of liabilities with 22%, and the increase of the stockholders' equity by 5%. Moving forward, the times interest ratio decreased by 16% because the interest expense increased by 23%, and the EBIT increased by 7%. Also, we can see that the equity multiplier increased by 5%. We can see that the equity multiplier increased by 5% because the average total assets outweighed the average stockholders' equity by 5%. Moving on to table 5, where we're going to see the profitability ratios of Intel Corporation.
Next slide.
I'm sorry.
As we can see also, we based our calculation on the 2019 and 2020. To start with the gross margin percentage, that relatively stayed the same with a slight increase of 5%, simply because the gross margin with respect to the sale was relatively high in 2019 compared to 2020. In other terms, even if both sales and gross margin were higher in 2020, but the increase of gross margin was lower than the increase of sales, which resulted in the drop of 5%. The return on equity was the same because simply the average stockholders' equity was the same in both years, and the net income was the same in the both years. We see it with 1% change, which is forward, which is the same change in the ratio. Moving forward to the explanation behind the return on assets staying the same is pretty obvious, because as the last started ratio, the net income stayed the same. The interest expense stayed relatively the same, and of course the average total assets is the same in both years. Last but not least, in the profit margin, there was a slight change that was about 2% decrease because simply sales dropped with 3%, and net income increased with 1%. Moving forward to table 6, market performance ratio of Intel Corporation. As already mentioned, we based our calculations on the 2 years, 2019 and 2020. And for the analysis of the market performance ratios, we can see that for the earning per share, it has increased with 5% because the decrease of the net income over the decrease of the average number of common stock outstanding decreased with 5%. and this returns to the decision of the company. It is true that the net income is not controllable. However, the company that decide to drop the common share outstanding, moreover, the market price per share soared with a 17% increase because simply the demand on the share was huge. So it resulted in an increasing the price earning ratio, which will benefit the stockholders and make more people interested in buying the stock of the company. Furthermore, there was something that is surprising, that is the dividend payout ratio stayed in the same, stayed the same, even if the dividends per share increased, and this is simply because of the earnings per share followed the trend if increase with the same percentage, and this can make us ask the question whether the new potential stockholders will be still wanting it because the price earning ratio increased while the dividend payout ratio stayed the same. Also, the dividend yield ratio decreased heavily because the market price per share increased drastically with regard to the dividends per share. Finally, the book value per share increased by 10%, which is surprising, but since the total equity increase outweighed the decrease of the outstanding ones heavily.
Thank you, guys. Thank you, Adnan. Thank you, Ayman. So as we saw from our analysis between the years 2019 and 2020, Intel Corporation downgraded, got downgraded in approximately all aspects, and we can see it from our ratios calculation and profitability change of the company. So thank you, guys, for your hard work. Thank you, doctor, for your interest, and thank you for giving us the floor to present to you our financial statement. Thank you.